Oh, hello everyone, and welcome to this Forex webinar for the London session. Thanks for waiting, and thanks for your patience. We were just sorting out our headsets and what have you, as usual. But before we start, can I just draw your attention to the disclaimer that I know you can see on your screen? As you know, trading can be a very risky business, so please don't ever think of using money that you cannot afford to lose. Okay, very quickly. We are going to obviously be looking at what's been happening in the world of Forex, and we are going to be looking at it through what we call the prism of volume price analysis. That's the way we do the technical analysis of the charts. In other words, we look at price action, we look at volume. But with Forex, you also have to look at the fundamental landscape, what's happening, what are the releases that are coming in today, and also what's happening in related markets in terms of sentiment, because there are certain currencies and currency pairs that are driven by what is going on in other markets. And in fact, in some ways, sometimes the Forex market can lead what may or may not happen in other markets. Now I've changed my slides around. Yes, I put this one in because normally we have this for our subsequent sessions, because what I'd like to do today is give you a kind of a practical example of what we mean by VPA. I've said it's a price action and volume, but actually it's slightly more than that. It includes, as we can see down here, it includes candles, candle patterns, and this really, really important element, which is support and resistance, which is an important element in technical analysis anyway. And what we say, and we say this in our program, and we have said this in the books, and we have said it, whenever we're asked to talk about the methodology, this is what we call your foundation. This is the foundation of your trading methodology, of your approach to how you break down what you see is happening on the charts. That's your starting point, as it were. And then after that, you can then start to apply your indicators, your any other tools, any other you integrate any other approach that you can have to help you make sense of the chart. And these can include standard indicators, as we can see here, moving averages, stochastic, fractals, etc., etc. What this does, what VPA does, it actually tells you how to use these in the appropriate way, because all indicators have been developed to highlight and confirm a certain phase of price action. But if you start with the indicators first, then you are kind of putting the cart before the horse, as it were. Whereas if you start with understanding how the structure of the chart through the prism of volume price analysis, everything will start to make sense. And on top of that, you can then add proprietary indicators, which we have, which those of you who I can see from the list here, we've got some of our quantum users, we've got some of our students. David and I have developed what we call proprietary ones, but they support the volume price analysis methodology. And everything is overarched by time, and not just time in the sense of the time frame that you want to trade, but multiple time frames. But again, it's best to see this on a practical example, as it were. And the reason we say, the other reason for looking at time in multiple time frames is because price action, the price cycle, is fractal. In other words, whatever you see on a minute chart is a mirror image of what you are going to see on a slower time frame. Obviously, it will take longer to develop. Right, so that's what we're going to start off with this morning. These are some of the proprietary indicators that we have developed specifically for the Forex market. What they do is they break down the Forex market into the flows. First of all, individual flows into the individual currencies we can see here on the currency strength indicator, and then these two indicators here, the matrix and the array, put those flows together and tell us which are the strongest pairs, which pairs are moving most strongly, either up or down, and then the heat map takes that information and spreads it out over the multiple timeframes on one chart, so you can monitor 28 pairs much more easily. What's the next? I think that's all on my thing. Oh no. The education program, I know some of our students are here today, so you are very welcome. Details of the education program you can find at quantumtradingeducation.com, and David can explain a little bit more about the program as we go through the session. And finally, as another option to the program, you have the option to become one of our funded traders, in which case you have the you simply apply and you can then trade our money basically at no risk to yourself. But as I said, I will get David to explain that as we go through this session. If you've got any questions, please just pop them into the chat box, and I'm more than happy to answer them either on air or in the chat box. Right, what am I going to do? I'm really going to start very quickly. This is the situation that we see here at the moment. I've got 3 time frames. Just to give it, this just gives me a quick overview of what is happening to the individual currencies and the currency pairs using the CSI and the matrix. And we can see here, this is the hourly chart, the 15-minute and the 5. And what stands out immediately is we've had a very strong selling in the New Zealand dollar in the overnight session. There's Aussie still has some way to go. If we look, when I said some currencies reflect sentiment, these 2 currencies in particular, from the Asian session, when I know, having looked at investing.com, having read my news feed, the Nikkei is up quite strongly. So the positive sentiment that we had in Wall Street yesterday has actually carried over into Asia, which explains why the New Zealand has been bought so strongly in this time frame. But as we can see here, we've got a bit of a rollover at the moment. It's actually been selling off in the faster time frame, so something has been going on there. Possibly now a potential trading opportunity maybe with the New Zealand. Also, as we're in London, the euro and the British pound always in focus, and we can see here that pound has kind of been selling off, kind of rising then selling off, but it's caught a bit of a bid. I think cable's caught a bit of a bid. David, you've got the British pound over on your side, haven't you? Yeah, David will be looking at that in more detail. With these crossover sessions, you may see a trading opportunity, but sometimes with volatility traps, etc., you do have to be a little bit wary. And in fact, on my website, if you go along, you will be able to read a post that went up on, I think it was Monday, and it was really a really nice illustration of what we mean by I don't know why my picture is not working properly. Let's have a look. Bear with me a second. I've got some lag on my on my internet this morning, so I do apologize. I can't seem to, things are taking an awful long time to move around. Right, you can read it in more detail at annacouling.com, but this is the kind of price action you have to be aware of at the London Open. This is actually the 6B, which is the futures contract for cable, actually, for the British pound. We can see here the British pound in sort of moving sideways. This is a 30-minute chart prior to the London Open. This is the London Open. You do have an increase in volume. As you can see, this is the volume prior to the London Open. Volume is relative, and you have to be read in context with the session that you are trading. Although this is a 24-hour session, you will get these peaks and troughs simply because the participation level is different. And London is also the premier centre for Forex, so you're always going to get massive volume, opening at the Open and throughout the London session. I think London takes like 43% of all the global flows in Forex, and given that they are billions and billions of dollars, you can imagine it's a very big percentage. Right, what happens here? What we see this is the London Open, then we have this massive inrush of volume on this candle here. What happens is the volatility indicator, it's an indicator that we have developed specifically to pick up momentum. Volatility is momentum, but it also picks it up and it measures it using average true range. So whenever that indicator is triggered, these little arrows, purple arrows are are displayed on the candle. Sometimes they're arrows, sometimes they're little dots, and that tells us that this piece of price action, the momentum in it, has driven this price action beyond its average true range for this time frame. Now, that is a huge warning signal, because it tells us what tends to happen is, first of all, one thing will happen is the price will retrace within the spread of the candle, and then it will either it could carry on higher, but more likely than not, it will then either congest or reverse. And especially coming at the London Open, this is exactly what happened. We had the retrace into the spread of the candle. Yes, we had some volume coming in, but look at the next signal. We had a shooting star candle on quite high volume, and then the reversal. In fact, straight back to where the price was at the open. And this is a classic trap, because when we see, as traders, this type of price action, the sudden momentum, this sudden movement in price, the first reaction, emotional reaction we get is, oh my goodness, I must get in because I'm missing an opportunity. And this is what fear of missing out is all about, and this is how it is triggered. But if you have an indicator such as this, which tells you this is what is going on, at least you are aware of it, and you think, haha, you know, you can manage that emotion. It's a perfectly normal reaction, and this is, you know, if you read the post, it is actually part of our DNA, right? So that's an example of what you can see at the London Open. But very quickly, I just want to run through these charts, because they are a really nice narrative of that house representation of volume price analysis, those elements that make up volume price analysis. Now, I hope this is going to behave itself, and I don't know why it's causing me problems this morning. I do forget.
Hi everyone, sorry about that. Anna's just sorting out. I think it's probably a conflict with the what's called the Epic pen. Certainly epic in terms of what it's doing to the system at the moment. Anyway, there we go. Let's start with, I'm on the Tradestation at the moment. I've actually got 3 platforms running. I've got this one, I've got TradingView on my other screen, and I've got NinjaTrader running behind this as well. Where should we start? Well, let's start with the currency futures. No, in fact, let's start with the currency futures. This is on, as I say, this is on Tradestation. This is Tradestation being driven by the Interactive Brokers account. It's what's called Tradestation Global, and it's a partnership between Interactive Brokers. Just move the trap box out of the way. It's a partnership between Interactive Brokers and Tradestation, which means if you have an Interactive Brokers account, you can link it straight through and trade through Interactive, but using all the tools and apps of Tradestation. It runs on version 9.5. I've got it running on the currency futures here. And basically on the left-hand side, we've got the radar screen, which is here, which is immensely powerful. All, or pretty much all, not all the indicators, but pretty much many of them we've coded for use in the radar screen, which you see here. And what radar screen gives you is an instant view across multiple timeframes. I've got these set up from 1 through to 15, but you can have any combination. You can have more than that, whatever you wish. But I've just set it up in this way to try and get as many of the currency pairs on as possible. So I've got the 6A at the top, which is the Aussie dollar. I've got the 6B, which is cable. This is not dollar CAD, this is CAD dollar. So this is the 6C. In other words, the dollar is always the counter currency in currency futures. It's just the way it's quoted. And the nice thing about it is that whenever you're looking at an array like this in terms of a matrix of pairs, you are looking at it through exactly the same prism. So everything, in other words, is pointing in the same direction. So if everything is blue or everything is red, it's telling you what is going on in terms of the dollar. I've got the dollar over on the right-hand side anyway. I'll pull that over in a minute on TradingView. So that's CAD dollar. This is Euro dollar normal, and this is New Zealand dollar. And then over here on the right-hand side, I've got the 6S, which is not the dollar Swiss, it's the Swiss dollar. So it's, again, it's the inverse, which is why you get strange numbers up the outside, up on the y-axis. The usual carry on at the open. This is what's been going on in terms of cable. Yeah, big surge in volume, as you would expect. Lots of volatility, as you would expect. Into the congestion phase. Doesn't look like we're having a reversal at present. Just keeping an eye on the right-hand side, see what's going on there. But at the moment, we are in congestion. No great surprise. We're trading around the volume point of control here, which is the pivot, the fulcrum of the market. So, it's no surprise that we're seeing congestion as well. This huge spike in volume here as we go through, this is London 8 o'clock, so we're now 35 minutes into the session. This is on the 5-minute time frame, and we're just trading in and around this these volatility triggers. And the reason that they are so powerful, not for us, but also for the market makers, is it triggers the emotional response of the fear of missing out. And if you see one of these, when the market rushes up, then your instant reaction is to jump in and try and join it, because you want to grab some quick pips, you want to make some quick bucks, and you see a fast moving market, and maybe you've been sitting through a phase like this, you've been waiting and waiting and waiting, and then snap, the market suddenly rockets and you think, oh, can't miss out, I've been sat here for a couple of hours, got to trade, and you jump in, and then you get the squeeze comes on, and the squeeze is either through congestion, which is emotional pressure because you're not sure whether you're right or wrong, or alternatively, you get a full-blown reversal, in which case you get taken out anyway. That's the power of it. The power of the indicator is very simple in the way it operates, because the beauty of it is it actually triggers in real time. In other words, you don't have to wait for the candle to close. So once this price action has moved outside the average true range on that particular time frame, it will trigger. So it'll tell you instantly that you have volatility. You'll see it anyway because it's very fast moving. And the expectation once you've got one of those is you're going to see some congestion follow, or you're going to see a reversal. And it's just a question of being patient and waiting either for that to occur or for the price action to clear away from the volatility. They appear in all time frames. They appear at particularly session crossovers, for example, particularly in London and the US session. You will also see them inevitably at places like the London Fix at 4 p.m. London time, which is another great place for seeing them, and also taking the opportunity because the market will be rushing up. The market makers will be pushing the price around to get their deals in place, and then you will see reversals take shape thereafter. So again, it's another great place. And of course, you always see it around fundamental news releases, big data releases, politics. We no longer have Mr. Trump on his Twitter handle, but he was a great volatility trigger as well. So you just have to wait and be patient. I've said it many times before, if you're in trade and you see one of these and it's in your direction and it works for you, fine, take your profit, close out, sit tight, bank it and wait. Or if you've got multiple positions, take 4/5, 80, 90% off the table, leave one to run. You can always jump back in again. So if you're in a single contract, then just take it out and bank the profit. If it moves you into loss, you've got a much tougher decision to make. But that's always my I'd say 99 times out of 100, if I have profit in the position, unless there's a strong reason to tell me that this is going to carry on higher or carry on lower in due course, then I'll close out and take profit off the table. So what we're seeing over here is just all the currency futures laid out. This is the trend monitor. So I've got the trend monitor on here, I've got the trend dots on here, and I've got the dynamic volatility. So you don't need to go hunting around the charts. Look straight at this. I can see that on the 30-minute for cable, 2 bars ago, there was a volatility trigger, and down you go. And it's just such a dream to have this information without having to hunt around. They're all linked. So if you want to move around to a different chart, you just click on this, and it will pull up the chart over here, and so you can literally scroll through this at speed. It's just a fantastic way of getting all this information. And what you're looking for in terms of several different aspects of it. First of all, you're looking at it from the context of, well, what is going on in terms of the dollar across the matrix, if you like. Are all these blue? Are all these red? What are they doing? At the moment, we've got some divergence because down here in New Zealand dollar, this is all pretty much red. And then we've got blue up on these pairs here. So in terms of what is going on in terms of dollar buying or dollar selling, right now on the 15-minute, it's kind of going sideways. It's starting to look a little bit weak. There's been a volatility. We had a rally up to about 7:30, and then the volatility came in there, and then we're starting to roll over a little bit, but it's kind of going sideways at the moment in congestion. So hence the reason we've got this sort of divergence across the complex. And I've got the CSI there as well. I've got two very simple tabs. This is on just moving to the NQ. Just want to get a fix on sentiment. What is sentiment right now? Well, again, you can see here big volatility spike, and you've got to remember this is on the Nasdaq, which is not open in the US. The US markets are still, the cash markets are closed. Everyone's still asleep, or broadly speaking, certainly on the East Coast at any rate. And this is what's going on in terms of market sentiment for a US market, which, you know, the cash market is not open. So we've had a big volatility trigger. Pop that up full size, see a bit better there. Big volatility spike. What are we seeing? We're seeing a reversal. Where is this going? Well, you know, we're coming down into some low volume regions here, so perhaps we're going to move through there fairly rapidly on the volume point of control, and then gradually, if we're going to move any deeper, this really does build out into the V-pot way down here. The NQ over the last couple of days has absolutely rocketed back from the loss of where are we now? Wednesday, last week. Where it sold off very strongly, but it's actually recovered. It's pretty much back to where it was at that point. Again, very simple. I've got the quantum trend monitor up here, I've got the trend dots up here, and I've got the volatility up here. And what you're looking for, I've got this set through from 1 minute right the way through out to the very slow time frames. What you're looking for is what we always talk about, which is a trend, a change in trend will always start in your fastest time frame. So what you're looking at here really is a visual representation of, I always use the analogy of the pebble in a pond. You throw the pebble in, and those ripples from that, from the pebble landing, then move out and away from the landing point. And it's pretty much what you see here. So what you're looking for in terms of a change in trend, the 1 minute has already changed on the trend monitor. You can see it here. We're red on the trend monitor. The trend dots are red, and you always expect the trend dots to change first. You can see lower down here on the 4, 5, and 10. They are already in transition. They've gone to the white, which is the intermediate. In other words, they've come off where they were previously. In other words, blue. They've gone into a transitional color, and ultimately they may well follow this group up here into red. And what you're seeing here is the same effect. So you step down onto the 2 minute. What are we seeing here? We're seeing a slight change on number 1 again now. And that's the whole point, is what you want to see is this effect rippling right the way down this ladder, because if it is a true change in trend, in other words, if this is going to go all the way back down to wherever it's going to, then it will be reflected across these time horizons. And it's a question of having this set up according to whatever it is you are trying to trade and the time line that you are trading in. Let's just drop that out of the way. This is on the, now we're moving to NinjaTrader. In fact, before I do that, let me just pull over Trading View. Just pop that up full size. And you had exactly the same. This is on, this is the FTSE 100, there we go. So it's mirrored. It doesn't matter what market you're looking at, broadly speaking, and this is not always the case, but broadly speaking, you should expect to see what is going on in UK markets reflected in what is going on in terms of US markets. This is obviously the cash market, the market open to date clock, so we're looking at cash here, but it reflects precisely what is going on in terms of Globex and electronic markets. You know, there is no difference. It's just the fact that this is cash and the other one is electronic. But other than that, the price action, the volatility, the general sentiment, you know, wonderful trap move. You can imagine all the FTSE futures traders jumping in on that one, you know, and now getting sucked in, and now they're regretting that decision because it's reversing back against them. They're not sure whether they're going to be taken out completely, but they realize what mistake they've made in jumping in too early, and they're now sitting there regretting that decision. It's just very straightforward, and it's just a question of being patient and waiting. I've got the volatility down here. We've got the pound yen up here. Let's pop that one up full size. There we go. Similar sort of thing. You know, volatility trap, weakness coming in here, lots of volume under that candle. It's not to say that this chart isn't going higher. Just expand it out a little bit, a bit cramped. This is not to say that this price action is not going to go higher in the longer term, but for the time being, it's a question of sitting tight, waiting, and waiting for the price action to move away, looking at the volume associated below, and all the other indicators, which will give you all that information. The other thing I wanted to show you here very quickly, oh, by the way, before I forget, just down to our little, where are we? Here we go. This is our FXCM account. For those of you who come along regularly, you know that we're just trading this in, I'm using, and I'll restate what I'm doing here. I'm using one tactic only and a particular time frame. It's just based on the 60-minute for the CSI, so I will look at the 30-minute and the 60-minute CSI, and it's based on a reversal. That's all I'm looking for. I'm not interested in anything else. I'm not interested in trading a trend. I'm not interested in jumping into something that's halfway gone. The train's left the station. You know, I'm not interested in that. I'm just looking at the extremes all the time for those particular time frames. So basically, it is one tactic only, and I'm constantly looking at the various currencies in terms of, I will trade that across any currency pair. So in other words, it's one tactic which is applied to all 28 currency pairs, but my focus primarily is on the yen, the dollar, and the Swiss franc, in other words, the risk currencies, and on the commodity currencies. That's my primary focus. So I'm really not interested in anything else on this. Yeah, the reason I didn't take it yesterday was because, as far as I was concerned, it was too messy, and that was certainly the case on Monday as well, where there was no clear divergence in terms of the grouping of the pairs. What I'm particularly interested in is when you see the franc and the dollar and the yen, when they are moving in the same direction, and equally when the commodity currencies are moving in the same direction, when they're all grouped together. Now, clearly you get divergence. We've had divergence on the Canadian. That's also been reflected over in oil, which is pushing higher. I think it's up about, we did a post on that yesterday. I think it was 54, 55. I think it's got 56 or 57, something like that, pushing on towards $60 a barrel. So that will clearly have an impact on the Canadian dollar. But that's what I'm looking for the whole time. It's very simple. I have very low risk leverage on this. I'm only trading one micro lot. That's all I put on. Whatever I'm putting on, I'll trade a basket. So I'll have 3, 4, or 5 contracts running at the same time. That's it. It very much reflects the risk profile that we've created on the funded accounts. They are leveraged at 5-to-1 on the evaluation phase and 6-to-1 on the portfolio manager level. And it's very conservative risk stop loss management, and this really does mirror it. And it just shows you. I think last week we were on 922.3, something like that. So we've had another 50 or 60 pips out of here, and we're just going to keep going. I want to get it up to $1,000, then we'll push it up to 1,500, and then we'll get on to 2,000. And as I said at the start of it, you know, if I showed you how to make $100 in a year, you wouldn't be terribly interested. But you know, that's 1,000 pips. So that's what it comes down to. It comes down to pip value all the time. If you're learning this business, when you first start, it's not about making money. It's about two things: finding consistency and being able to draw in pips on a regular basis. Because once you can achieve that, that's it. You're done and dusted. You can then move on, trade much larger size, move up the scale, add more money to your trading account, increase your lot size, and just rinse and repeat. That's all it comes down to, because you've proved you can be consistent. And that's why on the evaluation program, on the funded program, just move that out of the way. Oh, sorry. Yes, I meant to show you. Sorry, something else I meant to show you on this. That's why on the funded Forex program, when you start with the evaluation phase, that is what we're looking for. We're looking for consistency, because once you've got that, then we say, terrific, you've done that, you've proved it to yourself, you've proved it to us, and then we just multiply your trading capital by 4. So if you start on a $15,000 account with us, then you move up to 60,000, and thereafter it's always doubled. So it's 60, 120,000, 244.80, 960, and on up to the 2 million. Just wanted to show you the currency matrix, which I'm delighted to say is the first out the bag on the updates to TradingView. It's not been particularly straightforward, but we've managed it. You can see it over here on the left-hand side. I've got this isolated out on the pound at the moment, so you can see all the currency pairs moving up and down the matrix. The other thing about it is, as you can see here, we've also included the get that out of the way, go away. There we are. We've also included the. Let's just drop that back down there. Haven't done a great deal on this account, I have to say, this week so far, but you know, we'll keep that ticking over. You can see on the left-hand side there, we've got the all-time high and we've got the average, and then at the bottom here we've got the all-time low and also the average. We've added it to the matrix here. We will be adding it obviously through the platforms as we work our way through the year. It's just a nice feature to give you an insight into whether the value that you're seeing in the sell right now is high. Is it low? Is it average? You know, what is it? And it's the one thing that was missing from the matrix, I think, which we've now addressed. So you now get a sense, you can see possibly up there right at the top, pound New Zealand is 6.61, the all-time high is 8.88, and the average is 6.29. So it's kind of at the average. Down at the bottom, similar, New Zealand Swiss 6.6, 6.7, the average is -8, and the all-time low is -10.7. It just gives you a sense of a benchmark, if you will. It's a little bit like the 80-20 on the currency CSI. It will just give you a benchmark of where that value is and whether there is further headroom to go. In other words, you know, are we at the extreme or is there a little bit further to go? So it's just another way of looking at that data. And it's similar, as I say, like this, you know, the 80-20 up here, these levels, it just gives you a sense of when a currency is overbought, when it's oversold, so on and so forth. Very quickly hop onto the charts, see what we've got in here. I can't remember which one I've got on here. I've got Aussie yen, okay, fine. This was a snap on Aussie yen and would have been reflected, of course, in the fact that when we were looking at the indices, whether you're looking at the UK, whether you're looking at Globex, you know, you see that volatility come in and you think it's a trap. It's either going to go sideways or it's going to reverse. So this has come off pretty much big time. This is 8 o'clock London time, initial surge, that's the volatility trigger. And then you get an absolute ton and a half of volume coming in under this particular candle. What is that telling you? It's really just confirming what you're expecting from this one, but it's really giving you a very strong perspective on what to expect next. In other words, you've got masses of effort, but not much in terms of the reward. And that's all it comes down to. It's the analogy I use all the time is of you're driving up an icy mountain road. It's getting steeper, you're applying more pressure to the gas, and eventually you're slowing, and eventually you get to a point where you can apply as much pressure as you like and you're not going anywhere. The wheels are just spinning, in other words. And that's all this is. It's just the volume here is telling you loud and clear that this is heavy selling pressure in this particular candle. In other words, the price is being dumped in here. Traders who've jumped in here or traders who are late comers to this one will be buying in here quite happily. They're quite happily being sold to under this volume, and then it's going to reverse and they're going to be trapped and taken out. It's very simple. This is basically Wyckoff's third law. It's just effort and result. Are these in agreement or disagreement? Very simple, they're in disagreement. Why? Because if this were true, if we work off, and remember, we can't go back over here because this is European, so we're looking at whatever's going on in this area here. But if this first candle is true, we've had this much price action on this much volume, and then we get 1.5 times the volume and a very narrow candle. So this can only be heavy selling, end of the story. It's a very simple analysis from just one quick candle. The story is always across multiple time frames. I've got the very fast time frame here, 15 second. I'm not suggesting you have to use 15 second, but again, it's one I use a lot because it goes back to that, what I was saying earlier about the pebble in the pond. You drop the pebble in and the price action ripples out. So where you're going to see it develop first is obviously in your fastest time frame. More volatility here, another volatility trigger here into this one and reversed again. That's the power of the indicator. And if this is going to be a true change in trend, in other words, reverting back to the bullish sentiment, you're going to start to see it here. You can start to see the very first signs of it here. Nothing here as of yet. You wouldn't expect it to see on the trend monitor. And of course, it'll go right the way up. On terms of the 30-minute, you know, it's still telling it's bullish. So if I were in this, holding this position for a different time horizon, in other words, my 30, 60-minute over on trading view, I wouldn't be too fussed about all this at the moment. Obviously, I'll be looking over at the CSI, what's going on in terms of the CSI and everything else in terms of sentiment. Can I pass back to you, darling?
Yeah, sure.
Let me pass back to Anna. Hold on.
Back to, actually, I've got MT4 here. And just to give you how my profile is set up for the Euro CAD. In fact, all my profiles are set up like this, like both for MT4 and MT5. Essentially, I've got 5 charts. I have the daily, I have the hourly chart, I have a 15, I have the 5, and I have a Renko chart. And on the 15-minute and the hourly charts up here, I don't have all the indicators on. What I'm really looking at on these 2 time frames here is I'm looking at levels. I'm looking at key support levels, both primarily from price-based on these 2 time frames, and I have the our standard support and resistance indicator. This is this sort of little hatch line, and sometimes there's a solid line which tells me that it's a stronger level. But the key to this are these levels here that you see numbered. There are actually 6 levels, and these are based on our Camarilla indicator. There are 6 levels. Most Camarilla users only use 4, but we've extended it out to 6. And the reason I have them both on the hour and on the 15 is because the levels that are displayed on the hourly charts are valid for the rest of the week. These are the levels that are in play between Monday and Friday, whereas on the 15-minute chart, they are recalculated every day. Every time, once rollover happens at about 10 o'clock tonight, then you get a fresh set of levels. And that is really important because, as I said earlier, support and resistance is a huge part of VPA. And what we have to try and identify is, well, what are the important levels? Now, we use Camarilla. Some people use Fibonacci. You know, it's however you want to highlight them on your chart, but it's really important to know where these key levels are, because it's at this point that price will either stop, pause, reverse, and congest. And without having some kind of hierarchy to these levels, you have no idea, well, is that an important level or is that not an important level? The 5-minute chart has our other indicators on, and the beauty of the Renko chart on MT4, you can't do this on MT5, unfortunately, is you can actually put the Renko on the, you can put the Camarilla on the Renko as well, and that makes it really, really useful. And it's obviously the daily values that go on to the Renko. And what the Renko does, as well as giving you potential entries and exits, and also when you hold onto a trade by using what we have, you've got the colored bricks, but they are supported with the trend dot and the trend monitor down here. And essentially what happens is when these 2 are in agreement, that's the trend dot and the monitor, and you get this wonderful, geometric pattern start to develop, that is when you could look at potentially entering. So we see here, we have this, the trend higher with all the blue dots and the blue bricks, a little bit of a pullback there. Then it hits a resistance level. I've also got the support and resistance level on the Renko chart as well. And we start to see a pause and a potential move lower. The first thing that changes is actually the brick color that changes. Then the position of the trend dot changes. You can see here as the price moves up, that the dot will be beneath the price, whether it's a red candle, whether it's red or blue, telling us that it is supporting the price. Once that changes, the dot will change position, so it moves to the top of the brick, but the color may still be the same, although the price is moving lower. The monitor will not change immediately. That moves a little bit slower, but this is what you keep an eye on first. The bricks start to change, you get the transition color, which is the gray. So you know that there is something happening. There is a transition color down on the monitor, but it's when you get a more conservative entry would be when you get this matching of color between a bright red dot and bright red monitor, or in this case, a bright blue dot and a bright blue monitor. How that is reflected on the price chart, we will have a look on the example for the Euro Canadian, because it then comes down to whether you want to take a more aggressive entry, which is perfectly okay, depends on what your risk tolerance is as a trader, or do you want to take a more conservative entry? Now, taking a more conservative entry means that you will miss part of the move, but in trading, you know, you can't have everything. You can take what you have to take what the market offers you, and it also has to be based on how comfortable you are entering, as I said, on a more aggressive end. And aggressive by means of what I mean by aggressive is, well, you have, you know, how many confirmation signals do you have? Are you happy perhaps to take you know, with the trend dot and just a color change, not going to the bright blue, this intermediate color? Maybe the time chart is telling you, well, do you know what? You're probably okay on that, because don't forget you've got volume on the time chart. You won't have volume on Renko. Renko is purely on price action. If you look at the time chart and you look at the Renko together and you say, do you know what, I know that's saying, but I really want to see, you know, I want all my boxes ticked, as it were. And there's nothing wrong with that. It really comes down to how comfortable you are with taking any particular trade, and you have to be comfortable. You know, you have to manage the emotion of trading, and it's no good forcing yourself to take a trade where you are uncomfortable, and because it's going to be stressful. You're not going to enjoy it, and when things go against you, you know, you're going to be angry at yourself. You really don't want anger coming into your trading. You want to, you know, you want to manage your emotions. You want to be kind of almost semi-detached about it, whether it's a loss or a gain. You treat them in exactly the same way. And the other reason is to have the Renko, the Camarilla on here. It also helps to match it up with what's going on the time chart. So that's what's going on at the moment. On the daily chart, we can see here, this is the price action I was going to see from yesterday. This had quite a nice fall yesterday. Looks like it's carrying on lower. We've had the nonsense with the open over and done with. So we'll, you know, that may carry on further. How much further? Well, it depends. This is where we go and look at the levels. Where are we in terms of levels? Well, on the hour, they're clearly marked for us, because these levels are not just for entries, but they're also for points on the chart where the price is likely to pause. The most important levels, I would say, are the S3 and the S4, and we'll see that on the examples that I've got from yesterday. And crucially, on the faster time frames, it's actually approaching the S3 here on the 15-minute chart. So from this Renko, we have this little move lower, which is actually from this point of, as I explained earlier, how you can also use Renko to help keep you in. You can see the number of times it's pulled back, it's quite a messy trend at this point here. This has stayed red. We've had only three bars where we've had this intermediate a color change. So if you had got in above here, you would certainly have held on possibly to this point here, and you'd have said, well, do you know what, I'm not sure whether that's going to, you know, is that going to transition into the bright blue? You coming out, well, why not? There's nothing wrong with coming out with a profit. In fact, the Renko would have held you in, the monitor would have held you in, even this correction here, again coming up to the S1, but it's carried on lower. It's actually carried on through the S3. This is the key level now to watch. So in theory, you could have actually ridden that move all the way down. But I just want to go back to yesterday, and now my pictures are working properly. Here we are. Right, this is the CSI. It was about 11 o'clock London time. I haven't got all the other currencies on here because I just wanted to isolate them out. And this is what this really is related to the little account that we have over on David's machine, which is the FXCM account, where we just look. This is David's account. He just looks at extremes. This is what, you know, gladdens his heart every time he opens the CSI. Now, I just want to show you what. Now that looks. Let's have a look here very quickly if I can pull it up. Here we are. It was here and here, and although it looked fine, you say, okay, well this. I said, oh look, the going to be sell off on the Canadian dollar and possibly a buy on the euro. But as David explained, this was just one currency pair. What he liked, he has there's other criteria that he likes to use, because it's not just one pair that he wants to put on. So he said, yeah, that looks very interesting if you just want to use it, just one on its own, but it didn't fulfill all the other criteria, which he explained when he was talking about what he likes to see in terms of risk currencies. So, you know, where was the Aussie? There was it's quite a big divergence between the New Zealand, the Aussie, the Canadian. They were all over the place, and he doesn't like to see that. Where was the yen? Basically, it looked like it was a really nice, you know, potential setup, but in one pair. But because of the tactic to reversals, it isn't just on one. He likes to see other factors as well. But this is what they all looked like as of yesterday. But get back to my my photo. Here we are. So this is just isolating it out. There we are. So it looked like a potential reversal. That was fine. If we translate to what is happening on the chart, this is the hourly chart for the Euro CAD, and we can see actually that the pair had a you know, a very nice fall. They'd gone straight through the S3, and it actually then stopped. As I said, the two most important levels are the S3 and the S4. It didn't pause at the S3, it paused at the S4. You've got a really kind of waterfall coming up, and this is where you have this confluence with the CSI. As we can see here, this was the point where you had this overbought and oversold, but it hit these levels here. So potentially we are seeing a reversal. We see buying coming in, and we know there's buying coming in. I know possibly you can't see because it's hidden slightly with the arrows, but there are wicks to the bottom of these candles. So, you know, it was all supported with buying, and it actually went then back to the S3. The question to ask is, when you see the trading opportunities coming up based on reversals, is this actually going to be a longer term reversal, or is it just going to be a pullback and correction? Now, this is the hourly chart, and also if you as a trader are on the faster time frames, is this going to be enough for you on the faster time frames? So these are the questions that you have to ask yourself, and it comes down to, well, because we use the hourly for the account that we have over there, it is on the slower time frames, and based on, you know, what the other currencies were doing, this was of no interest, because as it subsequently turned out, it was a correction. If you were on the 5-minute and on the 15-minute chart, it actually turned out to be a very nice trade. But as long as you had the hourly chart there to tell you where it was likely to hold, where it's likely to come to an end, as it were. And if we move to the 15-minute chart here, because what the 15-minute chart, it actually expands what is going on that hourly chart. And if we go back a little bit further, in fact, there's this huge explanation of the analysis of the whole chart in terms of VPA, and it's on my Facebook page, which is if you type in my name, I think it's called Learn Forex, should know, Learn Forex Trading. All these images are there, so you can go through it, because it's a complete narrative, and it helps to break down not just what VPA is about, but also what to look for when you are, you have a live chart. So if we scroll back, you can see here, this move lower, if you like, started much earlier, obviously, in fact, yesterday, in Asia and in Europe. And in fact, it was a breakaway from a break low of what we call the volume point of control here, as we can see here. And the pair started to move lower. We had two volatility candles. Exactly the reaction was exactly the same. We had the first one, we had a retrace into the spread of that candle, but there was a lot of volume under the second one, and in fact it did carry on lower. So on the second volatility candle, there was another retrace and an attempt to rally off the S4. But if you look at the volume underneath those two candles, as I mentioned in the commentary over there, the key thing about these two candles is this: there was a deep wick to the bottom of the second candle, but the volume is lower than the first one. So that tells us that this sort of correction that's going on here, this pullback, is not, it's anomalous. There's much more downwards pressure on this move than there's not enough to move it back up. And in fact, it carries on lower, and then it comes to the point that we get to, that we saw the potential reversal on the CSI, and it actually gets to the last levels of our Camarilla. It gets to the S6, and this is where we actually get a really nice classic accumulation phase of price action based on VPA and Richard Wyckoff. And this is what you get. This is what we call our primary. This is our primary trend lower. Then we get a pause and we get a congestion. In the book, in the volume books that are on Amazon, one of the expressions we use is that trends are born in congestion phases. That's when a trend will develop. It could be a new trend, or even maybe after a pause, the continuation of the primary trend. But here we have a classic accumulation phase, and we kind of know it's accumulation as well, because if you look at the candles, the shape of the candles, they've got there's an awful lot of wicks to the bottom of the candles. You've got price support because it's at a key level, which is RS6, and I know we have some weakness coming in here, but generally speaking, if you look at this candle, this candle, this candle, this candle, they've all got wicks to the bottom of the candle. Well, what does that tell us? It tells us that there is likely to be buying there, and in fact, there was buying. So this is the accumulation phase. It does reverse higher, volume comes in, but then you come to these two candles here. You have a very widespread candle with good volume underneath it. You can't say that that's reasonable, but this is where your levels come in again. It's this candle which is key. We have a shooting star candle. It hits the S3. The S3 is such an important level for potential reversals. It's combined with a classic candle pattern, which is a shooting star, a ton of volume underneath it. That is your signal of weakness. This move from here to here, I think I said it was in the region of about, from top to bottom, about 60 pips, I think. So if you were on the 5-minute chart or the 1-minute chart or the 3-minute chart, then there is nothing wrong with taking this as a potential trade opportunity, but it was not an opportunity that we took based on the criteria that we have for taking reversals on the hourly charts, not because it wasn't a good trading opportunity, because it didn't meet the other criteria with regard to what the other currencies were doing. And in fact, once it came off there, as we can see here, if we take that as a primary trend, a pause, secondary, resumption of the primary, and down it went to the S6. So that's, and how was that reflected on the Renko? All the noise of the candles, you obviously don't get any wicks on Renko. You just get this beautiful geometry, this symmetry that you get on Renko. So this is our primary trend lower. This was the S6. This is what I'm saying. If you have having the Camarilla levels on the Renko chart makes life a lot easier. You have this accumulation phase. Then you have, this is this tradable secondary trend. Where would your entry be? Well, again, you would use support and resistance, you would use volume, you would use candle patterns. Once it starts breaking away, we have this matching of the two colors, and away we go. Now, when I said earlier, you don't see that. We don't see the shooting star on Renko because we don't have wicks. So when it hit the S3, knowing what we know about the S3, we can see the dots are still blue. This is most definitely blue. But because of what we saw on the 15-minute chart here with this weakness coming in, you could take the decision. You say, do you know what? And the volume that's coming in, this is actually going to reverse. Where you would possibly come out of this move simply based on Renko, well, you could come out here, or you could come out here, and you would say, well, okay, but if I'd stayed in, I would have got all that. Yes, but trading is not like that. That's in hindsight. You can only take the decision based on what you see developing at the time that you are in front of your charts. But having examples like this, looking at annotated drawings, it just gives you, it helps you to, it's a learning tool. And also the other thing about VPAs, these happen all the time. They're never absolutely identical, but you will always see a primary trend lower. You will always see some kind of congestion, some kind of accumulation, obviously distribution at the top. There will always be a level. There will always be some kind of reversal or correction. There will always be a candle and a candle pattern, and if you look at them and you put them together in multiple time frames, as I said, with we believe our indicators, they just give you that little bit extra help. They help to define these support and resistance levels, and they tell you the volatility that's coming in. They give you so much more information. It just gives you, we think, much more confidence to be able to take the trade. As I said, this move here was about 60 pips. So even if you've taken 10, 15, 20, I can assure you for traders on faster time frames, the average scalp is only about 6 or 7 pips. And as David said, it's consistency. If you can take 10 pips, it doesn't, on a micro lot, it's derisory. You think, well, why do I only want to take 10 pips? That's not the point. The point is, if you can take 10 pips consistently, you simply scale up your position size. Right. That's all I want. Is there anything you want to say on that, David?
No, way over time.
Way over time. Sorry about that. It was my fault because of the thing. Right. Question. Right. We'll do that. We'll do the tick later. Right. How do we use directional bias from higher time frames? Do you want to answer that one, David?
Yeah.
Once you understand trends, the key to this is you have to understand what is the primary trend and what is the secondary trend. You can have a primary trend in a slower time frame. So, for example, if there is a trend, first of all, you have to determine whether there is a trend. And let me have a look. I think the best word is move it here. Right, let's have a look. In fact, I think cable's a much better example of this. But let me have a look at cable because I saw this earlier on. Right, okay. Right. Do you want to do it on cable? Cable, if you look at right, the first thing you have to determine is what are your time frames, okay? That's the first thing. And you have to you have to decide, are you going to have a combination of timeframes that are on the slower end of the spectrum, or are you going to look at the faster? So that's the first thing. And in a way, kind of ignore what's going on at either end, as it were, because otherwise you'll just confuse yourself. The only exception to that is I would say is look at what is going on the daily. So if we look at the daily for cable, what is actually happening in cable? Well, there isn't a trend at the moment because it is in congestion. It is in it's not in a tight congestion, but you can see here we've had up days, down days, up days, down, up days. It's not in a discernible trend. Now, what that tells us about what is going on the faster time frames is that you are likely to get quite choppy price action. If you are in, this is a trend, when cable was in this this move over these number of days here, in this discernible move higher, we've got higher lows, we've got higher lows, lower high, higher highs. What am I trying to say? Higher lows. Here we are. That is moving up. On the faster time frames, the chances are that when there is a correction coming or a pullback, the bias that is on the daily time frame would probably continue. When you have this on the daily time frame, and remember, Forex is 3 distinct sessions. So, you know, what happens in one session may not necessarily carry on in another session. That means you're going to get possibly even more choppiness. So that's the first thing you have to bear in mind. And when you have a doji candle, as we have here, that is choppy whipsaw price action. So that is the, if you like, your trading environment. Doesn't mean you can't take a trade. It just means the type of price action that you can face. You then decide, you then say, well, I have that for context. I have the hourly chart, I have the 15, I have the Renko and the 5. And again, it comes down to what we saw in the Euro Canadian. It was very clearly in a downtrend once it moved away from the volume point of control. On the hourly chart, where are we on the on the 15-minute chart here, we can see that there was a discernible trend here. So if you wanted to trade that to the downside, you would look at a faster time frame. That is your dominant trend, if you like, in this time frame. You then come to the accumulation and you have a reversal. If you are still on the 15 and you look at the hour, and that is, you know, you determine that is your dominant trend, this reversal here, that could be of interest to you only if you are on the faster time frames. I'm sorry if, you know, as I said, it really comes down to understanding primary and secondary trends, how they evolve and develop in the different time frames, and whether a secondary trend in the time frame that you are looking at is, you know, does offer a potential trading opportunity or not. But it comes down to, you know, keeping a focus on the time frames that you are trading. I find using the Renko chart, you know, helps to really clarify whether the primary trend is going to continue. Are we going to get a reversal, or is it just a pause point, or, you know, the primary trend is then going to continue? And obviously looking at the time chart and looking at volume. I'm just going to pass to David to see if he's got anything else to say on that.
Hopefully you can see my screen. I'm just on the tick charts. I think the person who asked that question has actually left the room, so I won't bother going through that in great detail. But yeah, just to wrap up on what Anna was saying, first of all, it is covered in huge detail in the Forex education program. And secondly, it is a question, the analogy I've always used in the past, and you may have heard it before, is really of a racehorse. Racehorses are blinkered to force them to focus on the finishing line. And in a way, it's the same here. It's a question of focusing on what you're trying to do in that particular time horizon, and not moving out to slower time frames to try and validate your decision as to what you've done in your faster time frame, or vice versa. Because the whole business, you will find, if you are trading long, you will quite happily find an opportunity short in a different time frame. I can assure you that may be a few time frames away, but I can assure you it will be there, because this whole business is, and particularly so in the currency markets where it is all about mean reversion, it is wheels within wheels. So the fastest wheel may be going in, if you imagine a watch, for example, one wheel will be going in one direction very quickly, as we are here, for example. We're on the 15-second, 30-second, and 1 minute. I'm on tick charts here. Now, you know, I'm not going to sit here and trade this over hours because it doesn't make sense. All I'm interested in here is literally smash and grab, get in, get out, get in, get out. That's it. But that is not what I'm going to be doing, for example, on the FXCM account, the little FXCM account on TradingView. I have no interest in what is going on in tick charts at this sort of level. I'm interested in a much longer term picture. So I don't care whether this is going up and down, sideways, whatever it's doing. It's just doing what it's doing. So you have to focus in. That's the analogy of blinker yourself. Just focus on 3 time frames in whatever you're trying to do, whether you're trying to trend trade longer term, whether you're trying to scalp for ticks on fast charts like this. That is what you have to focus on, and really be as disciplined as you can. It's very easy if a trade's not going quite in your direction, you tend to go out to slower time frames and think, oh, you're looking for validation, you're looking for confirmation. It's called confirmation bias. If you've made a decision, you want it to be confirmed, so you go and look at the slower time frames. If you've bought a red car, you want to make sure that there are lots of other red cars around, because it then validates your decision. That's the way we're made. It's just human nature. So yeah, this is tick charts. So, you know, we're very quick here. We're looking to scalp in and out. There's been some nice trades on here, nice reversal. We had a big sell-off, then we had a nice big reversal. That be reflected in volume. Now we're moving into congestion over on the 15-minute. Just pull that over. I mean, that's where we are on the 15-minute time frame. So if you're a 15-minute trader, you might now be looking at this as an opportunity. You've got decent buying coming in here, lots of volume, big wick to the lower body. So there is definitely some stopping volume coming in here. You know, you might be looking at that on a 15, 30-minute hourly time frame as a potential reversal to start buying that particular currency pair. That's what it comes down to. I'm going to wrap up very quick because we're way over time. Sorry about that. This is the education program, 2 parts to it. This is where we started the complete Forex trading program. That's what we've called it because that's what it is. It's huge, it's immense, it covers everything you need to know. Oh, you are back. Sorry, Francisco. I'll go back on that in a moment. So that's the actual program itself. I think there are something like 450 odd modules in there, or lessons rather. You've got all these modules: psychology, fundamental, relational, technical, the mechanics of trading, teaches you how to trade, what you need to think about when you're trading, how to manage your trades. All of that is in there. And then you've got this massive array of videos, VPA chart examples, how to use the indicators, pulling it together, topic webinars, webinar library, and resources. It's all in there. And the reason we bolted the funded Forex program alongside is because it's optional. You don't have to join, you don't have to trade our money, but it's there if you want to leverage your knowledge. Once you've learned how to trade this market, you then have the option to apply for a funded Forex account. You start with either 5,000, 10,000 or 15,000 on the evaluation stage. It's very simple. We've actually, since we launched this a few months ago, we've actually increased the profit return to you. So that's now increased to 50% on the portfolio manager stage, which is the next level up. Once you've done your evaluation stage, which is on 5, 10 or 15, as I say, we then quadruple the amount of capital. So from 15 you go to 60, and then we double it thereafter. You hit the targets, you're earning all the time, and we've increased that to 50%. We've also made some other changes there. One of them, the most significant changes we made in terms of what you can trade. On the portfolio manager stage, you can only trade the 28 currency pairs, but once you move through that and into portfolio manager stage, you can trade primarily the indices and also gold. So it broadens it out a little bit for you as well. This is where you can find all the indicators at quantumtrading.com, MT4, NinjaTrader 7.8, TradingView we're working on. You've seen the matrix, we're working on the array. There's a little bit of an issue on the array, but we're working on it. And the Tradestation, you've now got 9.5 up and running with interactive brokers, and you've got version 10 with Tradestation securities as well. And finally, this is where you'll find Anna over at annacouling.com. All the books up on Amazon and all the links to the site, and you'll find all the blog posts there as well. Just drop that out of the way. Let's go back on to the tick charts here. This is on the tick speedometer. I've got this set up very quick to reflect what's going on here. So basically, I've got the time charts at the top, 15, 30, and 1 minute. Same down here. I've got 15, 30 second, and 1 minute. So this, the tick speedometer, is basically delivering the optimal setting for you. This is telling me I need to change this to 55 ticks. I'll just do that very quickly there. There we go. This is on 89, so that needs to change as well. It was running much quicker earlier on. Now it's slowed down a little bit. And this one is running at 233. What this is telling you, the orange is telling you, the green is where we've got lots of activity. We've got volume coming in. We're expecting a shift. You start to see it because you've got an injection of momentum from the volume. So it shifts to green. Basically, if we're running in red, or orange is preferred, orange is the average, if you will. Now you're starting to see it pick up speed. And what you'll see with the tick charts is, and you can see you've got the indicators on here as well, what you will see with a tick chart is raw momentum, because this is no longer based on time. This 55 tick is once the 55 ticks have gone through this candle, it moves on to the next one, and so on and so forth. So there is no aspect of time, but the reason I've got it matched with the time up here is because you get obviously you can see the VPA applied, but you can also apply it through here. It's exactly the same way. This is the same volume. You can see we're picking up speed here. We've moved into fast. We've got volume coming in, so there's an injection of momentum coming in. We've got back to slow. This constant fluctuation. This is where you're scalping. You're scalping for a few ticks here. You're not staying in here for hours. You're not staying in here for half an hour. You're in and out, constantly in and out, grabbing ticks, grabbing pips, whatever it is you're trading. And as you can see, the indicators working exactly the same way. We've got the trend dots, got the trend monitor on here. Sorry, just get rid of that. And you've got the volatility up here, so you see volatility coming in on 1 minute, so you expect a bit of congestion to build. Is it going to break away from that? A little bit of weakness under here, you've got volume under here and a bit of a spike to the upper body, etc., etc. That's how quick you've got to move. You've got to be really quick down here. This is not about getting in and staying in. This is jumping in, grabbing, getting out, jumping, grab, get it out. Simple as that. But it's all here, and basically what the tick speedometer does, it delivers the optimal setting, because otherwise it's guesswork. If I change this over to a different currency pair, then it would give a completely different array of settings. If I go to an index, it'll be vastly different on the ES as opposed to the YM and the NQ. The ES is a massively traded contract, so the tick values will be huge, whereas the YM is less so, and therefore the tick values will be lower. You put it on gold, you think gold is heavily traded, you'd be surprised what the optimal tick settings are for gold. Very different. And that's why you need the tick speedometer, because not only does it deliver all this visual stuff, it also tells you the optimal setting to set these charts to. These will change. The reason there are two values here is this number here, which I've set them to, will change less frequently. You can see this changes all the time, the actual. So it's a question of whether you select the actual and change it, or whether you go with the one that changes less frequently. It's nothing to do with Fibonacci, other than it's just a mathematical tool for us to deliver something that is slightly more stable than the actual, which changes all the time, as you can see here. So I will tend to use the fib number. If it's a little bit slower moving, perhaps in Globex only, then I'll tend to maybe go to the actual and change it less frequently. So that's it. We're going to run because we're way over time. Thank you very much indeed for coming along today. Hope you enjoyed it. I hope you've learned something perhaps you didn't know before. I think that's all the questions on. Great. Thanks, Francisco. I'll try and do that again maybe next week or later and go through it in a bit more detail, perhaps not quite so rushed there. So we will see you later. We are back at, what time are we back? 2:15, I think. Don't quote me, but I think it's 2:15 for futures and then 3:15 for stocks. So we will see you later. Enjoy the rest of the trading session. Looks as though the pound's coming back a bit. And as I said, that buying that came in over on, there we go, let's pull it over. Just show you the power of VPA. Move that out of the way. There we go. Where do we see it? Stopping volume coming in here. Off up we go. There we go. That's the power of VPA. See you soon and see you later. If not later, we will see you next week. So thanks for coming and bye for now.